What if I told you there's a trading tool that's been around since the 80s, a favorite of pros, but it still kind of flies under the radar for most people? Well, today we're pulling back the curtain on exactly that, the Camarilla equation. Let's get into it.
And that really brings us to the big question, right? Could a formula that's over 3 decades old actually make a difference in how you navigate today's super fast-paced markets? I think you might be surprised.
So, let's rewind the clock. The year is 1989. A successful bond trader named Nick Scott discovers this unique mathematical relationship in the markets. It's a formula that just nails these key intraday levels over and over again, and he gives it this really interesting, mysterious name. He called it Camarilla. Now, what in the world does that mean? It's a word for a small, tight-knit group of confidential advisors. And honestly, that is the perfect way to think about this tool. It's like having your own secret advisor whispering the most important price levels in your ear all day long.
So, how does this so-called confidential advisor actually work? Well, it's all built on one incredibly simple but really powerful idea about how markets move, something called reversion to the mean.
This quote just says it all. The fundamental idea is that price is kind of like a rubber band. It stretches away from its average, but it almost always has this tendency to snap back to the middle. It zigs and zags, but it gets pulled back. Until, one day, it doesn't. And the absolute genius of the Camarilla equation is that it gives you a game plan for both scenarios.
Okay, so how do we actually get these magic levels? Let's take a look at the blueprint. Now, it might sound complicated, but the beauty here is in its simplicity. And don't worry, you're not going to have to do any math. Pretty much every trading platform out there will calculate these 8 levels for you automatically.
The entire system, all 8 levels for today's trading session, is built from just 3 super simple, totally objective pieces of information from the day before. There's no guesswork, no complex analysis, just pure, simple price data.
And here they are. Seriously, this is it. All the formula needs is yesterday's high, yesterday's low, and yesterday's closing price. That's the whole recipe. The equation takes these 3 numbers and just works its magic.
So from those 3 little inputs, the equation projects a full-blown map for the current trading day. It gives us 8 distinct levels, 4 resistance levels above where the market closed, and 4 support levels below.
Now here are all 8 levels. S for support, R for resistance. But look, don't get overwhelmed. For our main strategies, we only need to laser focus on 4 of them. It's the 3rd and 4th levels on each side. So R3, R4, S3, and S4. That's where the real action happens.
All right, now for the fun part. Let's get into the actual game plan and see how these levels turn into concrete trading strategies. Because these aren't just random lines on a chart, right? They're basically calls to action.
The equation really gives us 2 main plays to run. First up, we have reversals. This is our reversion to the mean strategy. And second, we have breakouts. This is for those moments when the market decides, you know what, I'm not going back to the mean, and just kicks off a powerful new trend.
So let's break down the reversal play. Your key zones here are R3 and S3. Think of them like invisible walls. When the price rallies up to R3, traders are watching for it to hit that wall and get rejected. If it does, they can enter a sell trade. On the flip side, if the price drops down to S3, they're looking for a bounce to go long. And the best part? It has built-in risk management. You just place your stop loss right beyond that next level, R4 or S4, which keeps your potential risk nice and tidy.
But what happens if the price doesn't hit the wall and reverse? What if it just smashes right through it? Well, that's our breakout play. A strong, confident move through that R4 resistance or S4 support level is a huge signal. It tells us the reversion to the mean idea is off the table for now, and a powerful new trend might be starting. In that case, you trade with the momentum. The key word here, though, is strong. You want to see conviction, because in really choppy markets, you can get false signals.
Now you might be thinking, okay, this is cool, but I've heard of other pivot points. And you're right, Camarilla isn't the only game in town. So to really get where it shines, let's put it side by side with some of the other popular options.
This little chart here is super helpful. You can see that standard pivots are kind of the all-around workhorse, and Fibonacci pivots are great in trending markets. But look at Camarilla. It has a very specific specialty. It is built for short-term action. We're talking day trading and scalping. And check this out. It adjusts really well to high volatility, which means it gives traders tighter, more useful levels when the market is going wild.
So what's the bottom line here? It's pretty clear. If you're a short-term trader, a scalper, or a day trader who needs to cut through all that intraday noise, the Camarilla equation was literally designed for you. It helps filter out the chaos and points you directly to high-probability turning points and breakout zones. Okay, let's do a super quick recap. Your Camarilla checklist. Number 1, it's a simple tool based only on the previous day's high, low, and close. 2, its core idea is reversion to the mean. 3, the 2 big strategies are trading reversals at R3 and S3 and breakouts at R4 and S4. And finally, its sweet spot is short-term intraday trading. Got it? Good.
Which brings us right back to where we started, with its incredibly simple inputs and its super clear, actionable game plans. You really have to ask yourself, could this elegant little equation from 1989 be the new confidential advisor you've been looking for in the markets?